All right, guys. Obviously, Monday, one of the worst days we've seen in many, many months. The stock market index is down about 3% across the board. Took some big hits from Apple and Amazon, some of the big names out there. It follows a terrible week last week. So a lot of talk out there asking, is a recession glooming? And the big point they keep referring to is what's called the bond yield inversion. Okay, and I want to show you what that means, what a normal bond yield looks like, and what's happening today, so you can kind of understand what they're talking about. Now, what you're looking at here is a chart showing the rates for 5 different bonds. And the lighter the color, the shorter the duration, the darker the color, the longer. So from the bottom, this is the 1-month Treasury bill, the 6-month, the 1-year, the 10-year, and the 30-year. And as you can see, the further out the duration is, the higher the interest rate or yield that investors are going to receive. And that's pretty normal. If you're going to hold something for 10 years versus 6 months, you don't know what's going to happen. You expect a higher rate of return. It's kind of how it's always been. This is very, very normal looking here. The longer the duration, the higher the yield. Well, let me show you what's been happening in 2019. Now, since the start of the year, see these dipped right here? See how the 30 and the 10 came down here right in the area of the shorter term durations? Let's look at what's happening today after this ugly week and a half we've had. And I'll show you where we're at now. Now, this is something you don't normally see. And the inversion they're talking about is when this 10-year note, currently at 1.75%, gets below the 1 month, the 3 month, the 6 months, because that's not how these things typically go. 10 years has a longer duration. You should receive a higher rate of return. And you see the sell-off we got here. So it's very, very rare that this happens. And it's pretty much predicted every recession for the last 50 years, they say. I think the average time is anywhere from 2 months to 2 years following a yield curve inversion that we tend to get something like that. So why does this happen? Well, it all has to do with how these bonds are bought. Bonds come to auction with a certain coupon rate. So say the 10-year bond has a 3% coupon rate. Well, that would be priced at 100 or par value. But when they bid the prices up, so it goes from 100 to 110, 120, you're paying more to get that same yield, so to get the same coupon rate, so your yield goes lower. So even though it's a 3% bond, since you didn't pay $1,000 for it, you paid $1,200 for it, you're really only getting 2% or 1.7%. And the reason those prices of bonds go up and the yields go down is because a lot of people are flooding money into them. So why would that happen? Well, if you've got tens of millions or billions of dollars, you can't put that in a checking account. So when you start getting out of stocks, you got to hold something. And they're holding bonds. That's kind of the checking account, the savings account, the super wealthy, and these endowment funds and hedge funds, etc. So when they're flooding money into the bond market, that drives the price of those bonds up and drives the yields down. So it's generally an indication they're fearful of the stock market and are flooding to bonds for safety. Another point of this is people are saying, hey, we're seeing that the Fed's going to have to cut rates again. And if they do that, the yields will come down. We want to lock in this 2 or 2.5 or 2.3% we've got today because we think it's going to be even lower going forward. And again, same thing happens. They're buying the bonds, drives the yields down. So this is the inversion. This 10-year note down here at 1.75, which is lower than the 6-month, it's lower than the 3-month, it's lower than the 1-month bond. That is not normal. So this is what they mean. You can look these symbols up. This is trading view charts I'm looking at here. The symbols are like US 06M for the 6-month and US 10Y for the 10-year. If you look at the futures, you'll see them going in the opposite direction because it's the price to buy the bond, which the higher the price of the bond futures, the lower the yield. But this is just showing you the actual percentage yield based on today's prices. I think it's the easiest way to look at it. On the upside, it's cheaper to borrow money. Mortgage rates just hit a 2 or 3 year low. I think the average prime is like 3.7 or something like that. So if you're in the market to buy some real estate, now's not a bad time to do that. So I hope that explains the bond yield inversion, what it means, why it happens, and how you can potentially use this to better predict market downturns.